Welcome, folks, to another episode of Burning Platform. You notice I don't have my usual sparring partner, Brian Summer, here. I found somebody much better looking and much smarter, especially about the topic we're about to discuss, Wall Street and enterprise software. Rob Kugel, ex-Morgan Stanley, now an industry analyst at Ventana, so he brings the combination. Rob, tell us a little bit about yourself, especially the intersection of Wall Street and what you do now.
Sure. Well, as you mentioned, I come at being an industry analyst in a very different way than most, in that I spent the first several decades of my career working as a Wall Street analyst, covering a variety of industries. And at the end of that career, I had picked up enterprise software in the early 1990s because it seemed to me that enterprise applications were going to be a huge business, which they actually turned out to be. But 18 years ago, I joined Ventana Research shortly after its founding to start the Office of Finance practice here, and I bring to very much a technology focus. What I bring to that is an understanding of the Office of Finance. I like to tell people, I'm deep in the technology, but I also read accounting bulletins. I'm a chartered financial analyst. I still pay attention to what's going on in the market. So I don't know, that's kind of a quick and dirty.
So Rob, Wall Street, clearly, just amazing where the Dow is and so on, right? And yet you hear from mainstream media, it is out of touch with reality, right? Partly because Main Street small businesses are really hurting. How do you see how Wall Street is behaving? It seems more in sync with enterprise software because that is more corporate business that Wall Street is familiar with. But share your perspective on it. Is Wall Street out to lunch?
Okay, Vinnie. There are probably three things to consider. One is that Wall Street tends to be a leading indicator. So you can be, the economy can be totally down in the dumps. And all of a sudden, the stock market is soaring, and everybody goes, things look terrible. Then it turns out 9 months, 12 months out, we're on the road to recovery, and revenue earnings are coming back for the companies that are publicly traded. And that, I think, is the second difference, that, a lot of mainstream businesses have been hurt much more than larger enterprises, just because those larger enterprises have a lot more resiliency because they've got financing, they've got momentum, those sorts of things. They've got some fat that they can still cut and stick around. So I think that's another reason for the disparity. And a third factor is when we're looking at valuations, a couple of things to keep in mind. And one is that interest rates are effectively zero. And that's because the weight of money has been driving the prices of investment assets, higher and higher and higher. We have an inflation of the money supply. We don't have product inflation. We have wealth asset inflation, and whereas people find an escalating price in toilet paper and breakfast cereal to be disturbing, they feel absolutely brilliant when the money drives the price of their savings up. So I think those are some of the factors there. I don't know that it's sending much of a message broadly there, so just a couple of thoughts.
Well, toilet paper, at least if you can find it, you better be willing to pay for it. Talking about valuations and so on, clearly Snowflake, Palantir, C3, if you look at vertical plays like Shopify and Teladoc and telemedicine, collaboration plays like Zoom, any work from home benefiting company is doing very, very well, almost crazy valuations, right? You and I also advise industry customers. How should they filter or consider Wall Street's reaction, because they're usually looking for functionality, they're looking for TCO, ROI. How should they balance the two?
Well, let me divide that question up into two answers. To the first point, which is, we have, the NASDAQ has been soaring, tech stocks have been soaring, software company stocks have been soaring, and Shopify and other kinds of pandemic plays have been soaring. I think it's pretty straightforward. The market is telling you that the world fundamentally changed this year, and that while some things are going to go back to where they were beforehand, a lot of things aren't. One of the things that happened that was really profound, if you were in the software business, is all of a sudden those of us who've been saying, gee, you really ought to be in the cloud. Finally, a lot of CFOs went, I think I better be in the cloud for resiliency. When nobody could show up to, do the close, the financial close, at the beginning of April, what do? Well, the kind of made do. But mostly, I think what people in the finance organization recognized is we better go to the cloud. So it looks like, all kinds of investment now will take place in acquiring the means to be able to work virtually. Because when they got over the shock of, how are we going to do this? And then they discovered they could do it, they said, well, why don't we just do more of this? So I think there's, we've just seen the opening act of that. There's a lot more to come, because you can buy software, but you don't necessarily change your processes immediately. Or you've sort of changed your processes and you're going to buy software, but we're going to see a lot more of it. And so, part of that, and then also how people buy things. I've been a prime customer from the beginning, because I just don't want to get into my car and drive somewhere to buy something if I can just go click, 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 and magically it shows up. But a lot of people, weren't doing that. Now they are. So, definitely people are going to go back to stores, go back to malls, but not to the degree that they were before. And so part of what we've seen in terms of valuation is a recognition that a big chunk of the economy pre-2020 has now shifted to the post-2020. And all you have to do is think about business travel. Yeah, we're going to go back to traveling, especially if, you got to get more than, 10 or 12 people together at once for something. But the idea that I'm going to get on a plane and fly somewhere to have a meeting with one or two people, I think a lot of CFOs are going to say, I don't think we're going to spend that kind of money. And I think a lot of people will be very happy to just be able to, get on a call like the one we're having right now and do what they have to do. I think we've only begun to scratch the surface. A lot of people I know are sick of these kinds of communications, but I think really what they don't like is they don't like when there are a dozen, 15, 20 people on a Zoom call. And no, you can't. No, that's not what this technology does. But there's an awful lot of this stuff where you go, I got 6 meetings, in Atlanta. Okay.
So
no point in getting on a plane.
Second part of the question was, on how should we balance out Wall Street excitement, right? Because number of companies people hadn't heard about, right? Snowflake, people knew data lakes, but not quite as the valuation would suggest, right? Or Zoom, most people knew it, but then they also knew Microsoft Teams and so on, right? So from an enterprise buyer perspective, what would you say? Dampen down the enthusiasm of Wall Street, or give it any weight?
About the only thing I would pay attention to is negative sentiment on Wall Street. I think Otherwise I pretty much ignore it. The people who are investing in a lot of these companies are doing so for reasons that make sense for investors. And there's only a tenuous relationship between what they're doing and the stuff that you're going to buy for the next 3, 5, 10 years. They're, by definition, me thinking Snowflake is going to, rule forever, I'm very enthusiastic about it, and I'll be willing to pay up for it, believing that they're going to be the winner. Doesn't necessarily mean I'm exactly right for the long term. Besides, there are a lot of investing styles that are very short-term oriented that have nothing to do with the long-term fundamentals that one might assume is what's driving. So I just, I think you need to evaluate your options based on your needs, and only if people have, the stock's down 90%, maybe it's telling you something. Other than that, don't pay too much attention. Besides, there are plenty of smaller companies that aren't public, and they're worthy of your consideration too.
That's a great point. So, talking about small companies, start talking about, the startups and so on. It would seem like Wall Street is becoming more and more creative in terms of exits, right? So we have special SPACs, special purpose acquisition companies. How Palantir didn't really go public, right? So is that showing up in VCs saying, this is great, more exit opportunities? Or is it more the Salesforce, Slack, blockbuster M&A? How do you see the market evolving?
Well, I think there are a couple of different things. First of all, anytime you have big shifts in the economy or in financial engineering, you're going to get a lot of M&A. And we're at a certain stage here where, because of both of those things, I think we've got a lot of M&A activity in the future. But again, getting back to the enterprise software buyer, I'm not sure that's necessarily something.
Rob, on the M&A, I thought there would be a lot more bigger, healthier companies buying struggling SMB in technology. But something like what Salesforce is doing, 27 billion, that kind of threw me off a little.
Well, that's a one for only Mark Benioff can afford to make that decision. I don't think there are a lot of companies that are in a position to make that kind of a decision. Large deals don't have a good track record. We'll see how this one works out. Part of the valuation is if all of the cash that you're sitting on has no value, it's not generating any earnings for you. Okay, you can buy anything, and from that standpoint, it's not dilutive. But I think the other point you raised about SPACs, financial innovation, if you're old school, just reminds you that, oh, great, can't wait to figure out how this one ends in tears, because some financial innovations, do work out, but for the most part, these are just different ways of doing the same old thing. And I don't want to, tar every SPAC with the same brush, but it just reminds me of the old days when people used to do what were called reverse mergers, where you're a private company, you acquire a shell company that just happens to have a SEC registration, and then you go public with doing that. And I used to say about that, these are companies that wanted to go public in the worst possible way, and that's exactly what they did. I would never, I would never touch a company that did that, because usually they did that because they didn't want to subject themselves to the kind of scrutiny that you get through the standard IPO process. And I think that criticism has been leveled on SPACs. I think SPACs are a bit different. There is a certain amount of pedigree to some of these, where they have been vetted by fairly sophisticated and highly jaundiced people, so that, okay, this looks kind of reasonable. And the IPO process is long been criticized as being very expensive, and the underwriters wind up, slicing a big, huge thing off the top. That yada yada. And so, I think we'll see, but I think part of it is that there's a huge amount of money floating around there looking for investment opportunities, just like back in the 2000s. Everybody hungry for another eighth or a quarter point of yield started buying mortgage-backed securities. That didn't turn out too good. So, I think you have to, be very discriminating in, if you're going to look at a SPAC and do a lot of due diligence.
Thank you for that insight. You've obviously been there crunching those spreadsheets. So help me understand another thing that I've been surprised by. So SAP kind of, it didn't really miss, but they announced something cautious. My God, the stock got beaten down 35%. Workday, same thing. A little bit of caution and bang, 10% down. How do you crunch numbers that show that? Or is it more of a gut call?
No, I think that, you're crunching the numbers. And it's as much illusion as reality, honestly. The illusion. So what happened with SAP is, I think they're a victim of these CFOs going, I think I better go to the cloud. So they did, call out that part of the reason why they were a little more cautious on their revenue outlook was just that. So instead of getting a big, huge chunk of upfront money, they're now getting a subscription. And even though a 3-year subscription gets you a long way to what that, perpetual license was going to be, in terms of the total amount of money that was involved, every year it's going to be less. So, they've had to take their revenue guidance down, or moderate it, I should say, by that fact. I think there's also software isn't software. There is software that meets your immediate requirements in 2020 versus software that you'll get around to buying in 2021 or 2022 because, I'm going to go out and buy that, but not right now because my hair isn't on fire enough to make it essential that I go out and do this immediately. Meanwhile, I'm looking at an uncertain outlook for the economy, for regulation, for this, for that. So there, if there's no real pressing need, then I think a lot of companies kind of step back. But this is a far cry from what has happened, in the last 2 downturns, economic downturns, where really the software business got hammered, both in 2000 and 2002. And then, from 2008 to 2010, there were a lot more tears, and things that were going in reverse. This time around, I think, especially in the Office of Finance, you've got a willingness to invest. They got religion, and they said, "There's nothing stopping us." So we'll start. I need to be able to figure out 10 different scenarios and the cash flow implications for that. Well, good luck doing that in a spreadsheet at any kind of level of detail where you're trying to now mediate between, 4 or 5 major divisions and figuring out, how exactly should that play out. I mean, it's just, too much stuff there for a spreadsheet to be able to give you any kind of reasonable answer in a short enough period of time. So a lot of organizations said, well, I think we should get some planning software in. And those vendors have done very well.
Always good to hear your pragmatic viewpoint. And actually, you sound very optimistic. I mean, you make a good point comparing it to the two big recessions in the last 20 years. So, what else?
Well, the next thing to watch out for is tax, because for U.S. companies, I don't think a lot of people recognize that that big, huge tax reform that brought the rates down also brought with it the end of a lot of cushy things that offset the negative effects of that 35% statutory rate. Now rates are going to go up, but whoops, you no longer have the protections that you once did have in the past. So there's that, and especially for multinational companies, the challenges of transfer pricing and things. These are all. I'm optimistic, but but there are a lot of challenges ahead.
Rob, any final thoughts?
Nope. Good to see you again.
Good to see you. Good to see your Bay Area still alive and kicking, and in your virtual background there. I presume you're not out and about.
Yeah, this is the office I haven't been to since February. That's the view from my office, which I haven't seen in person.
Rob, thank you so much.
Well, thank you, Vinnie. It's been great chatting with you.